picture, Hang Seng though is seeing major gains right now.
Hero Motors earnings strong on all parameters. It was a beat across the board.
For the Bank Nifty, the all-time high at 44,152 is clearly in sight.
In the MSCI Standard Index, they will be using an adjustment factor of 0.5.
We had the highest ever level of individual loan disbursements in history.
Index on expected lines really 110 points lower. The twins are dragging.
We really like the two-wheeler space as being one that can benefit from this improvement in mass market consumption.
Performance has been very good for Tata Power and consistently 14 successive quarters.
So I expect the growth going forward also into mid to high single digit.
Market is on steroids. It's negating all the negative cues that we're getting from the global markets.
Manappuram Finance has said that they have repaid all the deposits except for a very small amount.
Lessors have filed irrevocable deregistration and export request authorization to the Director General of Civil Aviation.
It is a cautious Friday for markets. 103 points lower on the Nifty as we speak, and see the banking index.
9 lakh something, no? 9 lakhs.
Yeah.
Well, that was a day so far. You're with us here on the last closing bell of the week. It's a Friday. We are coming to you from the CNBC-TV18 News studios. I'm Prashant. With me, my colleagues Rima and Surbi here in the studios. Guys, hi.
Love it when you say that, Prashant. The last closing bell. That just has a great ring to it.
What if I stopped at the last closing bell?
No.
Well, Nigel is joining us from the newsroom floor. Nigel, hi, afternoon. Well, things are looking not very good, are they? And I think you can blame HDFC Twins squarely for it, as we've been saying from the morning. Actually, the HDFC Twins are responsible for a 150-point pressure on the Nifty. So that's what we have. Things are down. Autos as a space is doing okay. Metals are lower. So apart from banks, this is what is happening. I mean, largely the HDFC Twins is at play. Broader markets are not doing badly. I mean, from the morning, they're a little worse off as compared to the 2.5 odd is to 1 advanced decline ratio in the morning. But still, as compared to what's happening on the Nifty because of the HDFC Twins, it's not all that bad. On the way down, Nifty's got supports at 18,042 level. This is nothing but the low that we saw day before yesterday. We're about, 50-60 points away from that level. On the Bank Nifty, the support comes in at 42,603. So we're at, 42,872 or so, about 150 points away. And of course, there is more data out of the US later today. That's the big one, which is the jobs number, which we will get right around US opening bell. Rima, hi.
Hi. So just for starters, Europe and Asia is actually in a pretty okay place. Hang Seng closed out about 0.5%. The Taiwanese index also closes up in the green. Europe right now is trading with minor gains of 0.2 to 0.3%. So the fall that we're seeing is our own fall right now. That's point number one. Secondly, what Prashant said, HDFC Limited and HDFC Bank is dragging the benchmark index by nearly 150 points. 40 points. Out of that, 160 points lower is an account of HDFC Bank and HDFC Limited. So if it wasn't for that, the Indian markets, at least at the benchmark level, would have been in the green. In fact, what we've seen in the last 2 hours or so is that the Nifty has continued with its fall of about 120, 140 points. There you have it. The fall happened between 11 to 11:20, but since then, the markets haven't collapsed further or extended the fall. But the Nifty Bank continued its fall, and now the Nifty Bank has a cut of close to about 800 odd points. Mid caps today have snapped a 6-day winning streak. So even as an index earlier this week did see some profit booking, there was a day of pause, a day that we got gains, but the mid caps continue to rally up, and today is the first day that you are seeing some profit booking. Some of the gainers include Titan, that's index mover. In auto names, it's Hero Motorcorp, Maruti looking up. ICICI Bank in the private sector financial space is higher. And on the losing side, it's these two mid-cap earnings misses. Federal Bank 7.5% gone on the margin miss, and Symphony, weak all-round performance from Symphony. Margins have come down to 7-8%, and the street is disappointed.
Yeah, absolutely. I think today is one of those days where you've got some of these reactions which haven't gone down too well in terms of earnings for Federal. Let's pull up the Federal intraday chart as well. The moment that number came in, there was just disappointment all over, because this is one bank where the net interest income fell short of expectations, and that's not something we've seen across most of the lenders. It's been a quarter where most lenders have exhibited very, very healthy margin growth. For Federal, there was slight pressure on margins as well. Slippages, I mean, you could quibble here and there, but minor increase in slippages, not much. But short point is that in a market that got used to blow out financial numbers, whether it's the biggies or the mid-cap banks, Federal didn't quite cut it. And I think that reaction is quite sharp on Federal. Symphony, the net profit's down 75%. The margins have literally collapsed year on year. And that stock's under severe stress as well. Margins come down to below 9%. They used to be 22% a year ago. And that's again a disappointing number. Manappuram is the other one. You'll hear more about some of these stocks as we go along. Despite all of the reactions that have been coming in from the company, the clarifications, the fact is the price is under a lot of stress today, as the ED searches have continued for the company. So mid-caps kind of muddling along. Large caps, we have the overhang of the HDFC twins. So Nigel, for the bulls, not quite a Friday feeling.
Well, it got too easy for the bulls, right? Come in there, play, just take guard and smash it out of the park. It became too easy. Put writing became too easy. Buying the dip as well became too easy. And that's why the call earlier this morning was, take some money off the table, have a good weekend, just chill it out. And the data points as well today are telling you that, because the call writers, they are coming back in. It's not that the uptrend is broken, but there is a reason to have a bit of a pause. Till we hold on to lower levels, the 100 DMA, which is at around 17,800, I would think that the uptrend is still intact. But you can't participate at these levels, particularly closer to around 18,000. Because the 18,200 call, 18,150 call, both of them, they're the most active strikes today. So the call writers, they're feeling it, they have come back into play. On the downside, the 18,100 put as well is seeing a fair bit of open interest. So that's one of the puts that is seeing a fair bit of open interest. And the recent lows, that's the lows in this week, we've gone to around 18,040, 18,030, and from there is buying. So that's why I'm giving the support zone at around 18,020 to around 18,050. If that breaks, then you're looking at the 17,800, which is the 100 DMA. On the upside, though, I think we'll require a bigger queue. I don't know whether it's going to be the SBI numbers that come out in the next couple of weeks. But 18,250 to around 18,300, that's a bit of a resistance. If we can get past that, then I think the next target is directly at fresh all-time highs. 18,300, as positioning suggests right now, they're still in the game. So the bulls have partied all week, but the bears are going to go into the weekend on a high by the look of it.
Well, we'll keep an eye on those levels, but how should you position yourself in the last hour of trade? That's the question, isn't it? And what trades to take now? Mitesh is with us to tell us exactly that. Mitesh, good to have you back. What would you do?
Good afternoon, Prashant. I think, this fall, which started with the HDFC Bank and the HDFC Limited stock, what it's done is that, I was cautioning against the overbought position of the hourly and the 2 hourly charts. I think this has given mild negative turn to the indicator, suggesting that the pullback might last for some more time, few more hours, a couple of days. So I think traders should look at 18,070 as the immediate support level, which is roughly about 40-45 points away. And this is on the spot. And if that breaks, then I think, we might look at a slightly deeper cut to about 18,000, 19,000, 970 zone. That looks to be a good possibility. Therefore, I think we are avoiding longs on the index. If we see a reversal from 18,070, 60 zones, then maybe we'll consider long with a 30-40 point kind of a stop. But for the time being, I think the overall situation is not in favor of taking long positions on the index per se. Similar things playing out on the bank nifty, which appears to be already given mild breakdown on the intraday charts, suggesting that the bank nifty could test 42,600 to about 42,480 levels, and that's where we'll look at some kind of a bounce back from. So for the timing, trading is stock specific. Right now, I have one buy and one sell call. Ambuja Cement, after a long time, has come on the buy radar. I think it's giving a nice trading setup on the upside. Buy here with a stop at 395 for targets of 420, and ICICI GI. That's on the sell side. Sell here for targets of 1,040.
Okay, got that. Mitesh, thanks very much. We'll come back to you in about half an hour and get some more trading ideas in. But for the time being, let's stick to earnings. And we just saw numbers from Bharat Forge come out a while back. Well, you can argue that the revenue is more or less in line, but the profitability was a little below street estimates, which is why overall it's seen as a bit of a subdued quarter for Bharat Forge. To discuss the outlook for the company, we have Baba Kalyani, Chairman and Managing Director of Bharat Forge, with us on the line now. Thanks very much, Mr. Kalyani, for joining in. So you've done about 21% growth in revenue in the year that closed out, and we were reading some of the commentary as well, and you indicated that it'll be a good year. Most businesses will do well. And even the exports business, which has been the pain point of FY23, you're saying it'll revive. Can you give some more color? What segments specifically will drive growth for Bharat Forge in FY24? Can you better the 20-odd% you did in the last year?
Yeah, well, thanks for having us on your call. First of all, we now have almost 5 business segments that we have made in our company. Our main business segment, which is automotive components, which is Indian operations, is doing extremely well and will continue to do well. Our defense business has picked up hugely, and we see a huge growth in FY24 in that business. Then we have our industrial business, where we have acquired some new capacities in castings in the south. That is growing at a very fast pace and is EPS accretive right now. And our overseas business, which has been a drag on the last quarter, I think will turn around, and we should see in FY24 our consolidated EBITDA margins to be somewhere in the region of 17, 18, 19%, something like that. So I think we are looking at a very strong year going forward. We look at high double-digit growth in our business, and we look at almost all our businesses moving towards profitability.
Right, Mr. Kalyani, good afternoon. You're saying margins FY24 on a consolidated basis between 17 to 19%, somewhere there, right?
Yes, almost 500 basis points above what you saw in Q4.
Okay. And on the top line, would you want to put out a similar range? A high double digit?
Top line also will grow in high double digits. Maybe closer to 20-odd%. Or maybe a little more, maybe a little lucky.
So 20% top line growth and a 500. Your long-term debt has gone up on a year-on-year basis. You're ending the year with a debt of nearly 2,500 crore rupees, and your debt to EBITDA has also crossed the 1 mark, 1.01. Do you expect debt to increase further? And what's the debt to equity ratio that you're comfortable with?
No, first of all, our debt hasn't gone up. We have more than 3,200 crore cash on our balance sheet right now.
Okay.
So we are pretty comfortable with debt.
Okay, all right. Hi, Mr. Kalyani. Yeah, go ahead, sir.
Yeah. And we don't have a large capex plan for this year, for FY24. So we are quite okay, and I think we will generate a lot of free cash flow this year too. And the debt will come down. In the next 2 years, a large part of our debt will disappear.
Interesting. Hi, Mr. Kalyani. Always good speaking to you, sir. This is Nigel on this side. Besides your own business, the street likes to hear from you as well. Not only with regard to Bharat Forge, but if you're sitting on some cash and you're fairly comfortable, how interested are you in BEML? Now, the land assets. Mr. Kalyani, I need to ask you this because,
just like you analyze my balance sheet and my numbers, please do the same there and give me your opinion.
No, but I'm not going to be the one that's bidding, Mr. Kalyani. So I want to know if there is any movement, because in the past, I think you all have hinted, yes, we are interested. That land assets...
We have been interested. We are still talking to the bankers, but there are a lot of issues that need to get resolved before we can take serious interest in that. And
but couple of things...
at this point in time, there are multiple opportunities for us to grow. We are looking at growth. We want to grow our business at a very fast pace.
Right.
And, go ahead.
Yeah, so sir, so you're interested in the asset, but there are a couple of things that need to get cleared out. Now, one of the things was the land assets moved out. What else are you all waiting for? I mean, the assets become a little bit cleaner than what it was. But is there a debate on the valuations?
No, I mean, valuation is one problem. Manpower is another problem. Okay. There are multiple product lines, some of which we have no interest in. The third problem. So, there are multiple issues involved.
We say that the intensity of interest is waning because obviously it's difficult for you to remain interested at that same level unless issues get resolved,
Exactly.
right? Because
Exactly.
So, Mr. Kalyani, if not BEML, this is hypothetical, obviously, but you mentioned you have a fair amount of cash on the books. The business is going to throw up cash this year. Then, if not BEML, something else? Have you identified other potential candidates?
In last year, we just acquired 3 casting. You will see the numbers as they come out. We see a very, very high growth in that business. So our industrial business is going to start growing. And that's another area for us to diversify from automotive going into industrial products.
And just a quick final question in terms of diversification away from automotive, as a percentage of your revenue, how much do you see defense contributing in FY24 and let's say next year as well, FY25?
FY24, defense will contribute 10% of revenue. In FY23, it was hardly some 2% or 3%. So it is increasing to 10%. And I think if you go forward, FY26, it will be more than 20%. But our revenue will also grow quite substantially by that time.
Mr. Kalyani, you've given us a lot to chew upon. Thank you very much for joining. For defense contribution to pick up significantly, currently contributes in low single digits, will improve to 10% in FY24 and further to 20% plus 20-25% by FY26. Confident about margins improving by 500 basis points to 17-18% on a consolidated basis, a top line growth of 20%. BEML, not very sure. There are concerns on manpower, valuations, parts of the business that they're not very interested in. But they've just completed 3 acquisitions. Their focus continues to remain squarely on growth. Let's see whether they snap anything else up this year. So that's Bharat Forge for you. The stock is a bit subdued in trade, down 1%, because margins this time at least have come in lower than street expectations. But let's get into a break on that note. On the other side, we'll be joined by Sriram Velayuddhan of FL Securities to discuss the MSCI announcement on the HDFC Twins and what it means for the stock from here on.
The pursuit of inspiration, empowering visionaries to drive innovation. The pursuit for enduring growth, honoring game-changing achievers. The pursuit of unmatched legacy. 18 years and counting. The CNBC-TV18 India Business Leader Awards, as prestigious as the leaders they honor.
Standard Chartered presents India Business Leader Awards, a legacy inspiring excellence, in partnership with Hindustan Times.
Welcome back. The stocks undoubtedly of the day are HDFC Limited and HDFC Bank. Both are down more than about 5%. If you remember, towards the end of March, the company had updated its shareholding. And at that point, what we saw is that the FPI headroom in the companies had gone above 15%, which means it's eligible for a weight increase by the MSCI in the MSCI Standard Index. And whenever the FPI headroom crosses 15%, then the weightage increase, the free float weightage, or the free float factor as they call it, can go up to 1. That was the expectation in HDFC Limited and HDFC Bank. If that had been the case, if the free float weightage had gone up to 1, then it would have resulted in inflows of $3 billion, almost $3 billion. That was the expectation. But yesterday, MSCI came out with an announcement. There was a tweak that the free float weightage is going to be 0.5%. So that inflow of $3 billion is not going to come. In fact, the street was worried that we are likely to see some outflows. And this is what is putting pressure on the stocks today. So to discuss what exactly happened, what's the way forward, we are now joined by Sriram Veluyuddhan, the Vice President, Alternate Research at IIFL Securities. Sriram, afternoon, what exactly happened? Everyone was anticipating that free float, FIF factor as we call it, that weightage would go up to 1, there would be inflows in HDFC Twins. That hasn't materialized. So can you tell us your understanding of the situation now?
Hi, Rima. Good afternoon. Inclusion of HDFC Bank in the MSCI India Standard Index has been in focus. Now, in a key development announced today early morning, index provider MSCI has decided to add HDFC Bank in the MSCI India Standard Index, but with an adjustment factor of half. So while the index provider has acknowledged foreign room in the merged HDFC Bank is above 15%, albeit it's marginal though. So basically the measure has been taken to reduce the possibility of a reverse turnover. So as you pointed out, as against the earlier expectations of the event being a net inflow event of roughly 3 billion odd, largely the impact of addition of HDFC Bank in the MSCI India Standard Index is to be neutral now. As outflows of
But the foreign portfolio holding or the headroom is still 15%. So will they increase the weightage at a later stage from 0.5 to 1? And if yes, how will that take place?
Yeah. So how this will shape up is so the major agenda behind keeping the adjustment factor of at half as against 1, they would want to reduce the likely instance of a reverse turnover. So what I mean by reverse turnover is, let's say in the run-up to the August review, the foreign room again goes below 15%, which is a possibility because as per the March shareholding, 0.75% odd, which again is like to 15%. So as per the methodology document, let's say if a stock is part of the standard index and if in the run up to the reviews the room goes below 15%, the index provider applies the theory of concept of post adjustment factor. So in this case, let's say in the run up to the reval of the run up to the August review, if the room goes below 15%, the adjustment factor, let's say if it would have been at 1, again they would have been compelled to reduce it to 0.5 as per the methodology. So to avoid this, the index provider has taken this step. Now what will happen, to answer your question, let's say in the subsequent reviews, if the room again goes above 25%, then HDFC Bank's adjustment factor will be revised from 0.5 to 1. But as things stand, starting HDFC Bank will start with an adjustment factor of half.
Okay, got that, Sriram. But you know, I think this is the same maths that everybody's been doing around, let's say, Kotak Mahindra Bank as well, right? Because there the anticipation is that the weight will increase and it will see, Vivek was telling us, maybe, you know, inflows to the tune of $750 million. So you're saying, and in Kotak's case, I don't know if the headroom differential now is 25%. I think it's less than that. So how does it play out? You're saying for HDFC Bank, the factor will go back to 1 if the headroom is 25%, if I understood you correctly?
Correct, right.
Okay, so at a later date, are you expecting the index providers to increase the factor, and then therefore perhaps a lot of the selling that's happening now, maybe it reverses?
Now, these basically are like, large cap banks, Kotak Bank, HDFC Bank and all. So when we say that the room would go from, let's say 17.71 to about 25%, that entails a significant chunk of sell down by the FPIs in the stock. So in absolute, if one looks at these figures in absolute sense, at times we end up evaluating these figures for several quarters altogether, because the weight up in Kotak Bank, which is likely to happen in the May review, has not happened overnight. Or not over the last couple of quarters. So these figures, like, as I said, these are prominent large cap names widely held by FPIs, the active holders. So it would entail a significant chunk of selling by the FPIs over a period of time for it to go about 25%. It's not a very, it's not a figure like, which is very volatile and at a very brisk pace.
All right. Hi, Sriram. Good afternoon. Nigel on this side. I believe you're joining in from a vacation, but thanks so much for taking time off. I believe network as well is an issue, but good to have you on the show. So we've spoken about a couple of large names. We have the MSCI review that's going to take place. Any surprises? What are you working with, additions and deletions? And is there any dark horse out there?
Sure, Nigel. So, in one of our earlier shows, I had mentioned my expectations. So, in line with the names mentioned there, Hindustan Aeronautics and Power Finance still remain my high conviction inclusion candidates. I had mentioned about Cummins India Kirloskar. So, what has happened is subsequently these index rebal trades are becoming a bit crowded.
Is Prakash through? Is Prakash through?
Am I audible?
Please go ahead.
Yeah. So Cummins India Kirloskar post the discussion we had has moved down the pecking order. So in fact, Max Healthcare Institute has come above Cummins Healthcare. So I will stick with Hindustan Aeronautics, Power Finance, and Max Healthcare to get added in the quarterly review announcement, which is slated to happen next Friday early morning. So in terms of deletion, Indus Towers is the only name that appears on my radar. There are few other names as well which I am happen. As you guys have rightly pointed out, Kotak Mahindra will be up there, will be one of the key names there, followed by Interglobe Aviation, which is Indigo, Zomato, and Adani Ports and SEZ. So these are the names where I'm expecting a weight up to happen. On the other hand, Infosys, on the back of the recent buyback that closed a couple of months back, I'm expecting a weight down. So these prominently would be my expectations for the May review.
All right, Sriram, thanks very much. Enjoy the rest of your vacation. Appreciate you joining in with that. These index changes 10 years ago used to be, I mean, who cares, right? Yeah. But now, as Sriram is pointing out, it's...
serious money? Big money.
No, it's become very crowded. I mean, think about it, right? So, what did he tell? He told us his expectations of what may happen next Friday. So, first there is a rally based on expectations. Then on Friday, the announcement comes. It is effective a certain date 1 month later. Then the rally all the way till, the date of effective, whatever is the date of all of that goes into effect. And then post the adjustment, post the action, there is another round which takes place. So
one more event for the market, which
it's
keeps
just
traders busy.
which stage do you get in is the question, right? So it's become hard. The other point about HDFC and HDFC Bank for our viewers I want to make is this is basically some of the, not downside, but this is purely passive funds, right? This is index funds and what they're doing. This is not active funds taking a view on the stock or the other. Nothing has changed. It's just, passive funds who benchmark themselves to indices like FTSE, MSCI, etc., making changes because the index provider has made changes. That's it, nothing else. So these are very short-lived kind of moves which take place. Disappointment, sure, for those who were trading off of this news, but at the core of it, fundamentally, nothing has really changed.
Yeah, absolutely. Which is why I think it's a good time to get to Prakash as well.
Yeah.
We've discussed the technical factors which are leading to this kind of a drawdown on these stocks. Fundamentals are a different story. Prakash, good to have you on. Sorry, we've just had a barrage of earnings and all of these events happening today. Just want to get your view in. Purely from fundamentals, would you use a decline like today to buy in? How would you approach it? There's also a merger. There's so much going on with these two biggies.
No, absolutely, Survi. So I think you still have half an hour to do that. Don't waste that time discussing or thinking change perspective. Something which eventually normalizes or in equilibrium. So if HDFC Limited and HDFC Bank as a combined entities were to be looked at from a fundamental perspective, they continue to offer great value. And we've seen relative to that, ICICI Bank started looking attractive from a flow perspective. As Prashant very rightly said, these are temporary things, and the market is in no mood to commit long term. But it's more in the nature of anything that's in the nature of short term triggers gets kind of responded to very actively. But I think it's a great opportunity to add on to these names. The combined entity will be able to leverage so much of it positively that you regret not having it.
Okay, all right. Prakash, request you to stay with us. You have this knack of picking up some stocks when news flow is not too good. So I want to understand whether you're interested in Manappuram or not. But for the time being, let's hear out what's the latest on that. Yash has been on top of the story. The stock is getting hammered though. Yash, fill us in with more.
Nigel, since the time the Enforcement Directorate investigations have been, going on Manappuram Finance, the stock has been quite slippery. Now, just to sum up what has happened so far, the Enforcement Directorate or ED has searched 6 premises of Manappuram Finance, including the residential premise of its managing director, VP Nandkumar. The charges as per the Enforcement Directorate is that one of the subsidiary of Manappuram Finance, which is Manappuram Agro, took deposits from various people. This, despite not having the approval from RBI to take deposits. Now, the charge is that these deposits were essentially diverted into immovable properties as well as shares of Manappuram Finance itself. Now, as far as the allegations are concerned, there have been a lot of discrepancy between what ED has said so far and the company statement. ED says that it has frozen assets of the company worth 143 crore rupees, whereas Manappuram Finance has said that the shares itself frozen by ED is about 2,000 crore rupees. Coming to the next point, ED has said that Manappuram Agro Farms was not allowed to take deposits. Here, Manappuram Finance has said Agro Farms took deposits, but the funds were used in the business itself. Also, what ED said is that the funds raised from deposits were diverted into immovable properties, also invested in shares of Manappuram Finance, whereas Manappuram Finance has said that in the findings of SEBI and RBI, there was no adverse finding which both these regulators had come up with. Finally, ED has said that there were no KYC documents which were done for the depositors, and there is no proof that these deposits were returned to them after RBI's direction, whereas Manappuram Finance has said that they've repaid deposits, entire lot of deposits, except for a very small amount of just about 9.25 lakh rupees. As I said, the managing director has also said that he will seek a legal view on this entire action which has come from the Enforcement Directorate.
Okay. Thanks a lot for that, Yash. Well, Prakash, what's your take? Stock has corrected, from around 130 to around 105. Would you take the plunge, or it's a complete avoid for now? Let this dust settle, and then you'll take a fresh call.
Yeah, absolutely. I think it's a stay away kind of a thing right now, because there's so much of numbers which don't match and then don't kind of figure, and everything is flying around with a lot of confusion. So finally, the nature of the allegations and the remediation is something which we don't know of. So till that happens, it's best to look at something else. And as I said, there's such a lot of competitive intensity hitting them, these NBFCs, from the banks that have started looking at gold loans as a growth area, that it's best to keep away for the time being.
All right, fair enough. We'll take a very quick break here. We'll come back, continue our conversation, of course, on markets. We are down 175 points now on the index. So this is very quickly coming to, we're basically below 18,100 levels. And now 30 points, 35 points away from day before yesterday's low, which is a level I was asking you to keep an eye out on. 18,042 is that level, 40 points away. We'll take a break. We're back our calls with technical experts coming up in just a bit.
Welcome back. Federal Bank is under pressure. The management is now addressing the media post the Q4 numbers. Let's cut across.
On the credit side, continues to be very strong. We had flatteringly good outcome in Q4 in terms of credit costs at just 19 basis points, probably the best in class. And our coverage ratio through the year improved substantially. And so with an increased coverage, with credit quality holding, quite pristine, our risk-adjusted margins are tracking to around our desired levels of between 290 and 300 basis points, which effectively translate into supported by good fee income and efficiencies, translated into the bottom line progress that you may have observed. So on balance, we exited FY23 with very meaningful progress on most counts. The year is just about a month old. It has the same challenges that everybody is encountering in terms of how do we ensure that deposit growth comes back to the system. Credit looks quite positive. Quality of credit to bank looks quite strong. We about a month back a session where we outlined our plan, what kind of financial outcomes we expect, and we are tracking to those. So the year should reflect the improvements on many counts in terms of growth and supported by very high efficiency. Our fintech engagement continues to be extremely strong. Digital penetration and the outcome as a percentage, the number of customers using digital as their primary mode of engagement continues to be growing.
Okay, that's Federal Bank. We were actually just talking about this, I think yesterday or day before it was, that Federal seems to have broken out of this 130, 125, 130 kind of levels. Well, it's making us doubt that 8% lower with that earnings set 120, under 128. The Nifty is almost at the day's lowest point. We are almost 200 points down the index, 18,064, and what a fall we've had after the 100-point recovery that we had early on in the session. So second half of the day has all been down and out, down, making lower lows. Aditya Sood is with us, portfolio manager at InCred Portfolio Management Services. Aditya, good to have you with us here. Thank you very much for your time. Would you be a buyer of HDFC and HDFC Bank? Would you treat these 5.5% falls as opportunities?
Yeah, so HDFC Limited, I think so. Been holding the stock for close to 3.5 years now. Our belief is that, when you get a sectoral headwind in the sector, leaders who are gaining market share need to be bought into, and valuations are very, very attractive. So if you look at valuation vis-a-vis the previous cycle, obviously it was a much higher ROA business. The merged entity benefits are known, I think so, to multiple people. There are enough low-hanging fruits in terms of, obviously it is going to be a big part of the index as well. So we see this as a temporary in the share price. Obviously, it is a very, very strong franchise. It will continue to gain market share structurally. So we are structurally very positive on the mortgage business. That includes both large and small mortgage companies.
All right. Hi, Aditya. Good afternoon. Thanks so much for joining in. Aditya, when you send in some inputs, I want to understand stocks that can double or triple, say, in the next 5 to around 7 years. Or it has the stocks that have potential. I'm just going through a list, maybe Newlin, Finolex Cables, Intellilect, as well as BEML. Run us through the list, and if you could speak a couple of lines on a couple of them or on all of them.
So essentially, first of all, I think so you have to look at the backdrop of small cap performance in this environment. If you look at the Nifty small cap index over a 5-year period, returns have been, fairly dismal. Nifty returns have been closer to 11% CAGR. Nifty small cap has just reported at 3% CAGR. So I think so last year also we saw a very large divergence between small cap performance. So it has been a washout environment for small caps. There are at least 800 stocks which have corrected by more than 50% in last 2 years from the peak prices. Secondly, what we find is that the total addressable market for lot of small cap companies is expanding at a very, very fast pace. And, this includes companies like BEML. Obviously it is up for strategic divestment. But if you look at only the defense piece of BEML today, it is a 5,000 odd crore revenue company. Defense order book could be, as high as 15 to 20,000 crore over a 3 to 5 year period. So just imagine the kind of opportunity that one offers for BEML. Similarly, if you look at, Tejas or Intellect, for most of these companies is expanding rapidly because either they are gaining market share locally or they are gaining market share, globally. So if you look at a company like Tejas Networks, obviously the order book has doubled over last 1 year, from 900 odd crores to 1932 crores to be very precise. If you look at the BSNL tender, that is going to be a massive tender win for the company. It is going to be a 8 to 10,000 crore tender win. More importantly, this gives enough credibility for Tejas to be a global player, over a period of time. So what we are witnessing in the small cap is that, if you look at the past 10 years, the mortality rate of small graduating to mid and mid graduating to large has not really panned out. But what we see here is that, there is enough visibility in revenue. And some of these shifts are structural in the sense that, these companies have competency. So what we truly believe is that, this gives us a very good opportunity because of the market turmoil in terms of getting into companies at a very reasonable valuation level. So if you look at a Newland Labs, for example, the stock made a low of 250 rupees, rallied to 2850. It was the best performing pharma stock. Again, market gave an opportunity. The stock corrected to 1050. And obviously, the underlying business models are changing in the sense that, for a company like Newland Labs, what you'll find is that the high margin business, structurally, they reported a higher gross margin than DVs in the last quarter, and it has never happened in the company's history. So what we essentially see is that, there is going to be enough room for these companies to generate a decent returns over a 3-5 year period.
Okay, so those are some of the names that you like. I just want to go back to financials, Aditya. Hi, afternoon, Surabhi here. Because we've seen some very divergent trends and a few outliers. I don't know if you've had a look at Federal Bank of late, but I think the reason the market is disappointed is that this is a quarter where almost all leaders, even mid-sized ones, look at Chola the other day. I mean, people have reported blowout growth of the book on deposits and advances, sky-high margins. I mean, we're talking 5, 6, 7% margins. But here is a bank which has reported a compression in NIMs, a compression in net interest income. And I think that's something the markets are finding hard to digest. Any thoughts on Federal or otherwise any other mid-cap bank or NBFC sort of stock that interests you?
So we have some exposure in CSB and Equitas, and our basic premise in terms of small cap, favoring small cap banks has been that there is a divergence between the valuation of these banks. We have focused on categories wherein, you can have a price to book mismatch, so if you look at these companies, and we have used, 2% as a filter of ROA, whether Equitas can graduate from, becoming a 1.5% ROA to, I think so they are just there. If you look at a CSB, obviously they are heavily skewed towards gold loan. But what we also believe as a house is that, the best of credit cost is, sort of behind you. So if you have to normalize the cost, and it is the exact opposite, you cannot have this kind of credit cost going into a lending business from a 2 to 3 year perspective. I think so. The credit cost for most of the sector, is at the lowest point in last 40 years. So our view is that, this is a business which will report elevated credit cost. Obviously, there is a significant element of counter-cyclical buffer that ICICI Bank has, provisioned for, or the larger banks have provisioned for. But clearly, one would have to focus on credit cost and the provisioning numbers. So we are, slightly neutral to underweight on banks. Equitas and CSB have rallied by 60, 70% in a 6 months period. So what we believe is that, NPS can only shoot up from here.
Aditya, out of time. Thank you very much for throwing your insights on individual names, the financial pack as well. Back to the markets, we're pretty much at the low point of the day, and now names like Kotak Mahindra Bank, State Bank of India have dipped to the day's low. Mitesh Thakkar is here with us for a few BTST trades. Mitesh?
I have one buy and one sell. On the BTST side is Maruti. I think that's the stock which is holding out nicely in this entire fall, and overall setup is quite positive here. I would recommend a BTST here with a stop just below 8,900 and a target of 8,950. And National Aluminum or NALCO, that's STBT. Keep a stop at about levels of 81 and look for targets of around 78.
All right, got that, Mitesh. Thanks very much for the calls. Let's move on to an interesting story. This is coming in from the aviation sector. Airfares have surged significantly in the last 2 to 3 days after Go First cancelled its flights as it went in to file for bankruptcy protection. Now, with the summer already seeing a spike in ticket pricing, a further influx of passengers seems to have come as a good opportunity for other airlines to perhaps cash in on the opportunity. Let's straight away go across to Madiha to understand how big this spike is. Madiha, what are the numbers saying?
Let me first start with some context here, Surbi, before we get to the fares part. Go First was operating 180 to 185 flights every day and was flying about 30,000 passengers daily before filing bankruptcy. Now, with the airline getting out of the market, at least for the foreseeable future, the 30,000 passenger traffic gets directed to other airlines. And with many flyers making last-minute bookings now, all airlines who are seeing an uptick in demand are making the best of that opportunity. Now let's look at some of the routes that are seeing a dramatic spike. And I picked up routes where Go First operated more flights on these routes. So if you're traveling on the 6th of May, which is tomorrow, look at the Delhi to Mumbai fares. The highest fare is 28,000 rupees. The lowest on this route is 13,000 rupees. And if you look at the highest fares on other routes, Delhi to Srinagar is 34,000 rupees. Mumbai to Lucknow is 17,000 rupees. Delhi Delhi to Patna is 18,000 rupees. Mumbai to Ranchi is 19,000 rupees. Mumbai to Kochi is 28,000 rupees. And Mumbai to Kanpur is 18,000 rupees. I spoke to some leading travel booking platforms and they say prices are likely to remain high and fluid for the next few days before settling down at a level.
Madhya, just one thing, you know, the high and the low. So, for example, if you want to book a next day flight for Delhi to Bombay, you said the high in Delhi to Bombay is 28,000, the low is... So, the low has gone up because, I mean, next day flights, the peak would be quite high in any case, right? But the lowest, the cheapest available has moved up substantially. That's the way to look at it?
Yes, correct. You're right.
All right, fair enough. Madhya, thanks very much for that. So, that's the, costlier airfares.
Flying anywhere this weekend?
Not after what Madhya has told us. Not that I had any other plans in any case. But this ties in with what Ajay Srivastava was telling us, right? I mean, I think somebody else also yesterday was saying that... Mayuresh was saying that eventually, if this lasts for a long period of time, they were saying they were actually fearing that there may be some kind of government intervention or something.
Because as Madhya pointed out, I mean, it is a substantial fleet size.
Yeah.
The capacity that's moved out of the market, I think CS was estimating about 9 to 10%.
9% market share.
Market share. So there is a significant amount of capacity that's suddenly, gone out of the system.
But Delhi, you could easily book a flight for about 10,000. Cheapest is 13,000. So straight away, you're getting a jump up of close to about 30% there. Expensive, and it's come at a time. Get into a break. Here is a quick programming note. Our weekend special, Editors Roundtable, is coming up at 4:30 p.m. Let's get you a sneak preview on what are the big themes on today's show. The FIs make a comeback in India as flows have picked up in the last 2 months. Nigel will take us through all the numbers. This week, TVS Motors and Hero Motor both reported a beat in their earnings. However, if you take a deeper look, TVS Motors has outperformed Hero Motor significantly over the last 3 years. Sonia will take us through the full picture on the market share and the stock performance of these two two-wheelers. And staying with earnings, Mangalam will be there and he'll give us a roundup of all the numbers from the FMCG pack. Beyond Q4 numbers, has growth momentum sustained in April? What is data telling us? Prashant will get us the quick analysis.
Well, the guest in the show is going to be Agarwal of Demeter Advisors. He'll be joining us at 4:30 on some market conversation. So tune in, Editors Roundtable at 4:30 p.m. later today.
Welcome back. Well, let's talk about a few stocks then. Before going into the break, Madhya was telling us about how aviation fares are moving up. Amrish Palikal joins us. Hi, Amrish. Good afternoon. First of all, I hope you're not traveling because it's very, very expensive, as my colleague told us. But what's your take? How do you play this theme? Will you go and buy Interglobe Aviation, or do you believe if you're going on a holiday, there's another play out there?
Good afternoon, Nigel. In fact, I recommended Indigo, I think, just about 4 weeks back. And that was the first time I've, recommended this stock because the whole space was looking quite interesting. And with this, company going under, I think it's extremely good for Indigo as well as Air India, which anyway is not listed. But Indigo, I think the price should in fact go to levels of about 2,600. I'd given a target of about 2,380 that time. But now I think I should be revising that to about 2,500, 2,600. But then I have another stock, which anyway is from this similar sector, Mahindra Holidays. Because the way the hotel ARRs have risen, Mahindra Holidays membership has actually become quite attractive. They have about 281,000 members, which makes it around 57 members per room against the capacity of 50 members per room. They have a total of close to about 5,000 rooms around 102 resorts, including international destinations. And they have a step-down subsidiary called Holiday Resorts, which has about 33 destinations. And they also have a partnership with about 360 hotels chain. In FY23, they added 17,500 members, which was the highest till date. Resort occupancy is again about 84%. And on a standalone basis, they reported the highest revenue and profits in FY23. But the only issue was the subsidiary was pulling down the consolidated performance in the last 3 or 4 years. But if you look at FY23 numbers, they have witnessed a turnaround with an operational profit. Close to about 1,200 crores of cash in the books. And I think the next big trigger is that it's now more than 25 years of existence. So the initial set of members would be exiting soon. So the assets will actually become free of any holiday liability. And I think this is going to be a big trigger going ahead over the next couple of years. And if you do, valuation-wise, DCF plus sum of parts actually works out to about 550. Price target of about 450, which is about a decent 50% returns from here.
Amrish, any thoughts on Federal Bank? I remember this is a stock that you look at very closely. The street is disappointed with its earnings performance, and this is a bank which wants to be one of the top 5 private sector lenders in India. So the aspirations are very high. What have you made of the Q3 numbers, and is this fall of 9% a buying opportunity?
NIs, in fact, were lower than estimates. But then, I would say that this possibly could be a one-quarter disappointment because we have seen extremely good growth in the last few quarters. And if you see the rest of the sector also will actually see the NIM stopping off from the next quarter onwards. So I don't think there's anything too much to be worried about the Federal Bank. And in case the stock falls to levels about 120, 122, I think it's a very good buying opportunity. And we should remember that FedFina, which is a vertical of Federal Bank, which is to gold loans, that should be coming out with an IPO sooner than later because we had expected that IPO in FY22, but I think that IPO should come in FY24. And I think, that could be value unlocking for the shareholders of Federal Bank. So it's a buy at levels of closer to about 120.
Okay, all right, Amrish, we'll leave it there. Thanks very much for joining us and good speaking with you. By the way, in case of Federal Bank, if the market is freaking out about net interest margins coming lower as compared to the previous quarter Q3, the management themselves had guided that margins will be a little, it'll be difficult to sustain margins at those 3.5% whatever levels, and they would come off a little bit, which seems to be exactly what has happened. I wonder if we will start to see similar things across other banks as well, because, the lending side gets repriced immediately, but the deposit repricing happens slowly. And I think that is what has happened with the Federal Bank. So it will be interesting to hear the management's thoughts as we go along. But banks have been the focus today. The index ends down 2 1/3%, and not at the absolute lowest point, but nearly there. This is a 1,040 odd point cut. Nifty lost exactly half of what the Nifty Bank lost, which is about 1% or so. I just want to take a look at the mid-cap index. Much better, 0.75% lower on the mid-cap index. And I think the small-cap index also down about 0.75%. So Nifty 1 and Bank Nifty down over 2%. But of course, I mean, banks were the problem area with the HDFC twin seeing lots of damage. Prima.
Just on that subject about Federal Bank, I went back to see what the management said in Q3 about their NIMs. So they said NIMs will be 3.35 to 3.4% for the full year. So the implied NIM for Q4 was 3.44 to 3.48%. Right? This is what Nuvama has put out. The implied Q4 NIM should be 3.44 to 3.48%. Compared to that, the bank has delivered 3.31%. So there is that, miss compared to where the miss comes in from. But that's about Federal Bank. IT took a backseat today. The Nifty IT index itself was down close to about 0.6%, with individual names like Wipro, Infosys, all of them seeing a cut of more than 1%. Outside of the HDFC twins, you had Indices Bank, Kotak Mahindra Bank selling off quite sharply. But ICICI Bank, on the other hand, bucked the trend, and ICICI Bank closed up with a gain of about 0.5%. FMCG had a pretty resilient week, you would say. Titan was up 3.5%. ITC also closing up in the green, up 1%. Autos did well. Hero MotoCorp 1.5% up. Maruti Suzuki has gained 4% this entire week. So FMCG was resilient. Autos are seeing some buying. In the banking pack, ICICI Bank held up pretty well. And on the losing side, HDFC twins and IT broadly.
When you look at the broader volume sheet on the market, you typically find a lot of mid-caps, active trader-friendly mid-caps. So guess which of the stocks that are dominating the volume sheet today? It is HDFC, HDFC Bank, and even Indices Bank. So it's been that kind of a day, bit of an outlier by that stretch. Just quickly want to point out the disappointment on Manappuram. Final take on it is around 11%. BHEL saw lots of unwinding today, 6% down on that stock as well. Dabur, I mean, very severe result reactions today. Federal, we've been speaking about. Federal's final cut is about 8%. Dabur is down about 7%. Even RBL Bank, remember RBL was a little bit of a disappointment again when you're talking about tier 2 banking, and RBL has seen further selling pressure today. City Union Bank, another one on the way down. PFC losing some ground. Then the metal stocks anyway were weak, index and non-index. So SAIL and NALCO both have been on the way down as well. Symphony, another number that came out during market hours, 5.5% lower. So not a great day, except for some of the auto names. So let's not end with all gloom and doom. The tire guys have had a pretty good show this quarter. MRF has piled on another 3.5%. Remember, numbers came in earlier in the week. Today, more follow-through buying. CEAT was up 3.5% as well. And TVS Motors is riding home into the weekend in style with a 4% up move. So that is the market today. As Nigel said, really, the end of the week belonging to the Bears, a substantial 188-point cut on the Nifty, a massive 1,000-point drop on the Bank Nifty, with the index, the benchmark, back closer to the 18,000 mark. Well, that's where we are going to take your leave. It's a wrap from the entire team that puts Closing Bell together, but don't go anywhere. Our Friday special, Smart Money, is coming up next after this break.